What I'm about to tell you has cost some people everything. For others, it's a $10,000 penalty, and the trip to the bank that started it looked exactly like this. It's a Tuesday morning, nothing unusual. Coffee's made, news is on in the background. You've got an errand to run, same one you've run 100 times. A trip to the bank, you hand over your deposit, the teller types something, you get your receipt, 4 minutes, and you're done. Normal, routine, the kind of thing you've done your whole adult life without a second thought. But here's what you didn't see happen on the other side of that counter. Because of the amount you just deposited, your bank was required by a federal law that has been on the books since 1970 to fill out a form and send it to FinCEN, the Financial Crimes Enforcement Network, a division of the U.S. Treasury, which the IRS can and does access your name, your address, your social security number, the amount. You weren't told, you weren't asked, it just went quietly, automatically. And right now, this tax season, that form is sitting in a government database waiting to be matched against the return you're about to file. The habit I'm talking about isn't unusual. It isn't something only certain people do. It's something millions of retirees do every single week, depositing their own money, managing their own savings, moving their own funds, selling a car, getting a gift from the kids, finally putting away money you've kept at home for years, collecting a pension payout. These are retirement transactions. They feel completely normal because they are completely normal. But this tax season, those transactions are being cross-referenced against your tax return by a system that cannot tell the difference between you and someone trying to hide something. And for some people who did absolutely nothing wrong, that comparison is creating a very serious problem. The result for some people is a financial penalty. For others, it's worse. With probable cause, their entire bank account can be taken under civil asset forfeiture. No criminal conviction required. And once it's gone, the burden falls on you to go to court and prove you should get it back. We're going to talk about exactly how that happens and exactly how to make sure it doesn't happen to you. It's tax season, which means right now, you're probably doing exactly what millions of other retirees are doing. Gathering your documents, adding up your income, getting ready to file. Maybe you do it yourself. Maybe you've got an appointment with your accountant next week. Either way, here's what most people don't realize is happening on the other end while they're doing that. The IRS has access to every report your bank filed about your transactions last year, reports you never saw, reports your bank sent automatically. During tax season, those records are actively used to identify discrepancies worth investigating. And right now, as returns come in, that process is running. If everything lines up, the money your bank reported matches what you declared, you'll never hear a word about it. The system moves on. But if your bank reported a large cash deposit last year and the IRS cannot find a clear explanation for that money on your tax return, even if the money was completely legitimate, even if you were planning to report everything correctly, the system flags it. And that flag is what starts the problem. Not a crime, not a fraud, just a gap between two sets of numbers that an automated system cannot explain. So here is what I want you to do right now while we're talking. If you have your bank statements from last year nearby, pull them out or pull them up on your phone or computer. In a few minutes, I'm going to give you 4 specific things to look for. If any of them show up in your statements, you need to know about it before you file. Because finding it now, before you submit, is the best possible position to be in. There's still time to fix it. By the end of this video, you're going to know exactly what the habit is and why it catches so many good people off guard. You'll understand how the IRS system connects your bank records to your tax return. You'll hear the story of a 67-year-old grandmother who had $33,000 taken from her account without a single charge ever being filed against her. You'll see what the government's own internal watchdog found when it investigated how this law was being used. You'll get 4 specific things to check in your bank statements before you file, and I'll give you the one document that can protect you from all of it. And everything I'm going to show you today is documented. Real cases with real names, real law with a real history, a real government report written by the government about itself, not speculation, not scare tactics, because you deserve to understand exactly what's happening, not just be told to be afraid of it. So let's get into it. The habit is this: making cash deposits or cash withdrawals of amounts that are near but under $10,000, maybe $8,500, maybe $9,200, or making several deposits in the same month that together add up past $10,000. If you've done that, deposited money from selling your car, moved savings from home to the bank, put away a cash gift from family, you may have triggered something called a currency transaction report. And that report is sitting in a government database right now. A currency transaction report, sometimes called a CTR, is a form your bank is required by federal law to fill out and send to FinCEN, the Financial Crimes Enforcement Network, a division of the U.S. Treasury, which the IRS can access. This happens every time you make a cash transaction over $10,000. You never see it. Your bank doesn't ask your permission. There's no notification sent to you. It just goes automatically. Your name is on it, your address, your social security number, the amount. This law has been in place since 1970. It was designed to catch drug traffickers and organized crime, people physically moving suitcases full of cash. But today, it's reaching into the bank accounts of retirees making completely ordinary deposits. Here's the detail most people miss, and it matters. It's not just about a single transaction. The bank watches the entire day. If you deposit $6,000 in the morning and come back with $5,000 in the afternoon, that's $11,000 in one business day. One report gets filed, even though neither deposit crossed $10,000 on its own. The bank is watching the day, not just the transaction. And here's why this catches so many good people off guard. These are not suspicious transactions. These are retirement transactions. You sell the car you no longer need, deposit the cash. Your son gives you money to help with expenses, deposit the cash. You've kept savings at home for years, the way your parents taught you. Finally put it in the bank. You take a lump sum from your pension, you get paid in cash for some occasional work. Every one of those is completely legal. Every one of those is something millions of retirees do every year. And every one of those can put your name on a government report that gets cross-referenced against your tax return this tax season. The habit feels normal because it is normal. That's exactly the problem. So your bank filed a report. It's in Washington. Now what happens? When you file your tax return, the IRS has access to every currency transaction report your bank filed about your account last year. And they ask one question: does the money that moved through this person's account match what they told us they earned? If something doesn't line up, it gets flagged for review. Not always a human making a judgment call. Increasingly, data analytics doing the initial screening. Here's the specific problem for retirees, and it's important to understand this clearly. When you were working, most of your income was explained automatically. Your employer sent a W-2. Your bank sent a 1099. Everything had a paper trail the IRS could follow and verify without asking you a single question. In retirement, that often isn't true. You sell your car, no tax form gets generated for that. Your daughter gives you money, no tax form. You deposit savings you kept at home for 20 years, no tax form. An inheritance, no tax form. The money is completely legitimate, but the IRS system sees it arrive in your account and cannot find anything on your tax return that explains it. That gap between what your bank reported and what your return shows is the discrepancy. And the discrepancy is what starts everything. Now, I want to tell you something that your bank is legally prohibited from telling you. And I need you to really hear this. If your transactions triggered something called a suspicious activity report, a more serious flag that your bank can file when something looks unusual, your bank cannot tell you. It is a federal crime for them to say a single word about it. The law specifically prohibits it. Your bank could know right now that your account has been flagged. The banker you've said good morning to for 15 years cannot breathe a word of it. Not because they don't want to, because the law says they can't. The bank isn't your ally in this system. Through no fault of their own, they literally cannot be. Here's the timeline that matters right now. Your bank had 15 days after any large cash transaction to file their report, which means if you made any significant cash deposit or withdrawal last year, any month from January through December, that report is already in Washington. It was filed months ago. And right now, as you're gathering your documents to file, those records are being actively used to identify discrepancies. This isn't a future risk. This is a present one. This is why this conversation matters today and not 6 months from now. So far, we've talked about the passive risk. What happens when a large cash transaction triggers a report and gets cross-referenced against your return? That's the part most people don't know about. But there's a second layer to this, and this is the one that gets innocent people into the most serious trouble. It's called structuring. And the reason it traps good people is that it sounds exactly like what a careful, sensible person would do. Structuring is when you deliberately break up a large cash transaction into smaller ones specifically to stay under the $10,000 reporting threshold. Here's the clearest way to see it. Scenario 1. You deposit $12,000 in one transaction. Your bank files a currency transaction report, completely legal, no problem whatsoever. Scenario 2. Same $12,000, but you deposit $8,000 on Monday and $4,000 on Wednesday specifically because you want to avoid the bank filing paperwork. That is a federal crime. Same money, different approach, completely different legal outcome. The line between the two isn't the amount, it's the intention. The moment you deliberately break up a transaction to stay under the threshold and avoid the report, that act by itself is illegal, regardless of where the money came from. Now here's where it gets genuinely unfair for good people. The law does not care if your money is completely clean. It doesn't care if you are going to report every single dollar on your taxes. It doesn't care if you've never done anything wrong in your life. If you broke up those deposits to avoid the bank filing a report, that act is the crime, not the money. The intention behind how you deposited it. And the most common reason innocent people structure their deposits isn't to hide anything. It's because someone told them to. A friend, a family member, sometimes a well-meaning bank teller who said, "Just keep it under $10,000 to avoid the hassle." That advice, given with the best of intentions, can put you on the wrong side of a federal law. Let me walk you through 3 situations that your life might actually look like. First situation. You sold your RV for $22,000. The buyer paid you in installments, $8,000 one month, $8,000 the next, $6,000 after that. You deposited each payment as it came in. Is this structuring? Probably not. The payment schedule came from the buyer, not from you trying to avoid reporting. But it will get flagged, and without a bill of sale showing those payment terms, you have no easy way to prove it. Second situation. Your son wants to give you $20,000 to help with retirement. He gives it to you in 2 payments of $9,500, one in January, one in March. He's just trying to be thoughtful. But both of you could be liable for structuring. Neither of you knew the rule existed. The money was a gift given with love. Doesn't matter to the law. Third situation. You've kept cash at home for years, the way your parents taught you. You finally decide to put it in the bank. You deposit $9,800, then $9,500, then $8,700, each time a little under $10,000 because that's what feels like a reasonable amount to carry. To you, that's sensible. To the algorithm, it's a textbook structuring pattern. I want to tell you about Carole Hinders. She was 67 years old. She ran a small Mexican restaurant in Iowa. Her mother had built it. Carole had worked there for 38 years. Same booths, same customers, same recipes. She ran a cash business. She made deposits the way her mother taught her, keeping them modest, avoiding unnecessary paperwork at the bank. She paid her taxes every year. She had never been accused of anything in her life. One morning she was doing a crossword puzzle when there was a knock at the door. 2 IRS agents, standing on her porch. They didn't have an arrest warrant. They didn't have criminal charges. What they had was this. They had already taken her entire bank account. $32,820 gone. Her words, "I got a knock on the door, and it was 2 IRS agents who informed me they had closed my business bank account and seized all my money. How am I supposed to pay my bills?" She borrowed money to pay her staff. She used credit cards to keep the restaurant open. For more than a year, her life savings, 38 years of honest work, sat in a government account while she struggled to survive. She was never charged with a single crime, and she eventually got the money back. After over a year, after a legal organization stepped in to fight for her, she got it back. But that year, that was a year of her life she will never get back. Then there's Rolin, 79 years old, retired railroad engineer from Pittsburgh. His parents survived the Great Depression. They didn't trust banks. They kept their money at home, in envelopes, in the walls. Terry grew up that way. He lived that way his whole life. And when Terry moved to a smaller apartment, he had $82,373 in cash tucked around his home. Not drug money, not stolen, just decades of careful saving, done the way his parents taught him. He asked his daughter Rebecca to fly the money to Boston and open a joint account, a practical solution to a practical problem. At the Pittsburgh airport, a TSA agent flagged her bag. DEA agents took every dollar, no arrest, no charges, just gone. While the government held his money, Terry couldn't afford the dental work he needed. He drove a truck that needed repairs he couldn't pay for. For 6 months, he lived without the savings he'd spent a lifetime building. His daughter said afterward, "The fact that someone can put their hand into my pocket and just take it without cause was insulting to me as an American." They got the money back, after suing, after 6 months, with no apology from the government. Carole and Terry aren't isolated stories. Between 2005 and 2012, the IRS opened more than 2,500 cases just like theirs. $242 million seized, and those cases grew fivefold from 114 cases in 2005 to 639 in 2012. On average, the IRS held that money for 356 days before returning it, almost a full year. These weren't accidents. This was a system running exactly as it was being directed to run. Now I want to show you something. Not something I found, something the government found about itself. The Treasury Department Inspector General, that's the government's own internal watchdog, the office that audits what the IRS is doing, reviewed these seizures. 91%, 9 out of every 10 cases. The people who had their accounts seized, their money was completely legal. They hadn't hidden anything. They hadn't evaded anything. The law designed to go after drug traffickers was overwhelmingly being used against people with ordinary, legitimate money. And the government knew. This is their own report. The Inspector General also found something else. The Justice Department had encouraged enforcement teams to pursue what they internally called quick hits, cases where property could be seized and resolved quickly rather than pursuing actual criminals like drug traffickers. Drug traffickers have lawyers and resources, and they fight back. Grandmothers and retirees usually don't. So the system went after the easier target, on purpose. The phrase quick hits is in an official government report. And here's the fact that ties all of this together. The $10,000 threshold, the number at the center of everything we have talked about today, was set in 1970. It has never once been updated for inflation. In 1970, $10,000 was more than a full year's salary for most Americans. It was genuinely unusual to have that much cash. Today, $10,000 is a used car, a dental procedure, a new roof. The American Bankers Association, the organization that represents the banks themselves, says the threshold should be at least $65,000 to reflect what $10,000 actually meant in 1970. Last October, 9 United States senators introduced a bill to finally update it. Even Washington has admitted the system is broken. It just has not fixed it yet. And until it does, you're being monitored at 1970 standards in a 2025 world. Okay, let's talk about you specifically now, because the truth is the vast majority of people watching this are not at serious risk. But some of you are, and I want to help you figure out which one you are. Pull up those bank statements if you have not already. Here are the 4 things you're looking for. Number 1, any single cash deposit or withdrawal over $10,000. If there is one, a currency transaction report was filed. Do you have documentation showing where that money came from or where it went? Number 2, multiple deposits of similar amounts made within a few weeks of each other. $8,500, $9,000, $7,800. Does the source of that money appear anywhere on your tax return? Number 3, any large cash amount you received but did not report, not because you were hiding it, but because you did not know you needed to. A gift from family, a private sale, a pension distribution paid directly in cash. Number 4, any transaction where, if someone called you right now and asked where that money came from, you'd have to think for more than a few seconds to remember. If you went through that list and found nothing, you're genuinely fine. File with confidence. This video was useful background knowledge and nothing more. If you found something, do not panic. Finding it right now before you file is exactly where you want to be, because you still have time. And what comes next is simple. Here's your decision tree, 3 paths depending on what you found. If you have the documentation, a bill of sale, a gift letter, a bank statement, a pension distribution letter, file normally. Keep those documents for 7 years. You are protected. If you do not have the documentation but you think you can get it, give yourself 1 week before filing. Call the person who gave you the gift. Find the bill of sale from the vehicle you sold. Log into your retirement account and pull the distribution letter. Most of this paperwork still exists, you just need to find it. If you cannot reconstruct the documentation, talk to a tax professional before you file. Not after, before. A good accountant can include a note with your return that preemptively addresses any discrepancy the IRS might flag. That conversation costs you an hour. Not having it could cost you far more. There are 3 documents that protect you. They are not complicated. Any one of them can be handwritten. The bill of sale. Anytime you sold property for cash, a car, a boat, furniture, anything, you need this. Your name, the buyer's name, a description of what was sold, the price, the date, and both signatures. 1 page, that 1 page could be the difference between a clean record and a year of legal complications. The gift letter. If a family member gave you $10,000 or more, you need this. The donor's name, your name, the amount, the date, and a clear statement that it is a gift and not a loan. 2 paragraphs, that is all. The transaction memo. For anything else, a lump sum from your pension, an inheritance, savings you moved from home, print your bank statement, write a dated note explaining the source, and attach any supporting documents you have. Keep all of it for 7 years minimum. One more thing. If you're about to make a large cash deposit, or you made one recently that is now concerning you, go to your bank and ask to speak with a manager. Not a teller, a manager. You can ask directly, was a currency transaction report filed on my account last year? They are allowed to tell you. They cannot tell you about suspicious activity reports, those are legally confidential. But currency transaction reports, they can confirm. And if you're about to deposit a large amount of cash, you can walk in and say, I'm depositing money from the sale of my vehicle. I have a bill of sale. I want to make sure this is handled correctly. That 5-minute conversation creates a paper trail of legitimate intent. It costs you nothing. It could protect you from everything. Here's what I keep coming back to after going through all of this. Carole Hinders paid her taxes for 38 years. She made deposits the way her mother taught her. 2 agents knocked on her door and took everything. No crime, no charges, no warning. Rolin saved his money the way his Depression-era parents taught him. His daughter carried it to the bank. The government took it at the airport. No crime, no charges, no apology. These are not edge cases. The government's own Inspector General looked at 9 out of 10 cases just like theirs and concluded the money was completely legal. 9 out of 10. You now know more about this law than most people who have been caught by it. You know what triggers a report. You know what structuring is and why innocent people get caught by it. You know the 3 documents that protect you. You know what to check in your bank statements before you file. And you know what to say at your bank if you need to. That knowledge is real protection. Use it before April 15th. If this video helped you, if it made you check something you would not have checked, or gave you a document you did not know you needed, I'd genuinely love to hear about it. Drop a comment below. Tell me what you found, what your situation is, what questions you still have, and if there's a financial topic that keeps you up at night, something about your retirement, your taxes, your bank account that you've never quite gotten a straight answer on, tell me that too. That's what this channel exists for. You worked your whole life to build what you have. You deserve to keep it.